So again, the team at Anchor, we have offices, I think everybody on here knows, but it's in Rockford, Freeport, and Lanark. We have 5 advisors, including myself, and then a support team around that. So the topic today is 2025 tax changes, what you can expect and how it will impact you. IRS announced adjustments in October, and every year there's always some changes, and typically this has something to do with inflation. So there's going to be some adjustments to bring relief to taxpayers through increases in standard deductions, and there's more than 60 different upcoming changes in 2025 that we can expect. The 9 biggest changes, I just had a feeling I was skipping some slides here. Just wanted to make sure. The 9 biggest changes for 2025. As with any update, it's smart to consult a tax professional. So we are not, as financial planners, we are not tax professionals. We know enough to be dangerous, and we need to communicate that at the end of the day, you should consult with your tax professional. These changes take effect in 2025. So it's not when you file your tax return for 24 in the spring of 25. These are tax changes, calendar year 25, impact your tax return when you file that in spring of 26. So again, regarding the standard deduction, it's going to go up for about 90% or so of filers. This could mean paying less in taxes for those that don't itemize. It sounds like a great thing, but it's only going to increase by $400. So single tax filers can deduct $15,000. Married couples will be able to deduct $30,000 as a standard deduction. People that are filing head of household will be able to claim $22,500. The alternative minimum tax, keep in mind, I looked this up. This affects 0.01% of all tax filers. So it's probably not going to affect any of those that are on here, but alternative minimum tax exemptions have also been increased. And that increase is 88,000 for individuals and 137,000 for joint filers. This could result in some middle income earners no longer being subject to AMT because those limits went up. Typically, this is something that hits very high-end, high-income earners. So again, it's 0.01% of all tax filers, and it's probably not something you're going to have to be concerned with, but it does exist. Income tax brackets. The IRS has adjusted income tax brackets to accommodate rising wages. Predominantly, this is really tied to the cost of living adjustment, or what COLA is every year.
Said, well, the thing is, you don't have to do it forever.
What's that?
Oh, sorry, I got them.
Somebody's unmuted. Right, so the tax brackets have been increased. The top federal tax bracket's 37%. That's going to affect people 626 for single filers and 751,000 for those married couples filing jointly. So when we think about tax brackets, we need to remember that it's a progressive tax system. There's a portion of your income, whether you're filing single or joint, that is going to be taxed at 10%. There's a portion at 12%. And then there's a big jump from 12 to 22% is the next bracket. So we go 10, 12, 22, 24, 32%, 35%, and then 37%. Some of the planning that I think is most utilized is the difference, the jump from the 12% to 22% bracket. So the 22% bracket starts for incomes. If you're single, filing single, it's income over 48,475 taxable income. And for married, it's $96,950. So, for example, there is no capital gains taxes, or the capital gains rate, I should say, is 0% if you're in the 10 to 12% tax bracket. So that's something that a financial planner working with your CPA, accountant, can utilize. So you can take some capital gains and in theory not pay any capital gains. Another item that happens a lot, I would say, is if we have clients that are going to be in that 12% federal tax bracket, which goes up to about $96,000 next year if you're filing jointly, maybe a Roth conversion makes sense. As an example, let's say that your taxable income is going to be 56,000. We could do a Roth conversion for 30,000 and you would comfortably only pay 12% federal tax on that. So for the most part, those are the types of conversations that we'll be having with clients around tax brackets and taxes. Just know that there are some strategic things you can do if you have room within some of these tax brackets. Work hard, keep more. The IRS has raised the monthly allowance for transportation and parking to $325. Many of us might not have even known that was a thing. Employees can contribute up to $3,300 to Health Flex Savings Account, FSA accounts, with a carryover of $660. So if you work for an employer that have FSA accounts, that limit has been increased. Americans working in other countries can exclude $130,000 of foreign earned income, up from $126,500. So that has come up probably about a dozen times over the last few years where we had clients or their spouses working abroad, and that income can be excluded. Family-friendly policies. The earned income tax benefit for low-income families with 3 or more children increases to $8,046. For higher earners, this next bullet point really deals with estate taxes, the death tax. So federally, the death tax has jumped to $13.99 million. That's per person. So if a family has a $50 million net worth, each spouse could in theory shelter $14 million each, $28 million. Anything over that exemption, there would be a tax, federal death tax on that estate. While we're talking about, just know for clients that are in Illinois, the death tax is still $4 million, much lower. So in the state of Illinois, you can only exclude $4 million per spouse, per person. So 8 million if you're married, as an example. Anything over that, a rule of thumb would be 20% of that's going to go to the state of Illinois upon death. If you're single, it's 20% over 4 million. Backing up to the federal estate tax exemption, just know that in 2026, this is set to sunset back to like maybe roughly about 6 million. But again, a lot of this has to do with politics, Congress's policies and what they're going to enact. I feel pretty confident in saying I think that this federal estate tax exemption will continue to just be indexed for inflation. The maximum adoption credit has increased to $17,280 to cover those qualified expenses. One other thing, I know that the maximum annual gift tax exemption has increased from 18 to 19,000 in 2025. So if you're a family that has been gifting money to your children, as an example, and you were doing 18,000 last year, you can now do 19,000 to that child without impacting this federal estate tax exemption of 14 million. So if my wife and I, we wanted to give $19,000 to one of our kids next year, we could do that. I could do that. She could also do that. So you can give a total of $38,000 per person if you're married. And that does not impact this $14 million estate exemption exclusion. One of my favorite sayings, 80% of financial freedom is client behavior. What I mean by that, I think, is, money is an emotional thing. And as advisors here, we try to help our clients make non-emotional decisions or be the person that's going to hopefully be the reason. For example, let's say somebody comes up to me and says, hey, I know the market's going to go down, and they want to get out of the market. And then if you think about 2024, the market's up significantly. We want to keep our clients invested because you cannot predict the market. That's what I'm trying to communicate. So 4 tax tips to help you prepare for 2025. Max out your IRA. So for 2025, traditional and Roth IRAs, if you're under 50 years old, is $7,000 a year. If you're over 50, it's $8,000 per year. That did not change. 401ks, you can put in $23,500 if you're under 50, or you can put in $31,000 if you're over 50. That limit, I believe, went up $500. Contribute the maximum to a traditional IRA can reduce taxable income. Roth IRAs are not tax deductible. So, once you have a Roth IRA for at least 5 years, you can make tax-free withdrawals. So making that decision if you should save pre-tax or after-tax into a Roth, whether that be into your IRA or a 401k, really has to do with your current tax situation today and your anticipated tax situation, tax bracket upon retirement. It can also have something to do with, I would suggest, how much of your portfolio you're planning to give, how much of your portfolio you're planning to spend versus pass on to the next generation. What I mean by that is, let's say somebody's fortunate to have a pension, they also get Social Security income, and they get $100,000 a year, and that covers all their expenses. That individual or couple, they might not need their $1 million in their investments, and it's just going to be passed on. So sometimes, depending on what the purpose of the money is, it would be advantageous to maybe save after tax or in a Roth IRA or Roth 401k to set up the next generation more beneficially. So those are just a lot of different things to think about. Sometimes which one is better impacts you personally. Sometimes which one is better impacts your legacy and who you're leaving the money to. So there's a lot of things to consider. Another thing my mind just went towards, you can contribute to a 401k and you still could be eligible to contribute to an IRA. So just know that in some situations you can do both. Offset gains. If you have investment losses in 2024, you can use them to offset your investment gains and ordinary income up to $3,000. So if you have a situation where you had a capital loss, $30,000 5 years ago, you can use $3,000 of that per year until that's exhausted. Or you could sell and take gains to offset the losses. If you sell an investment at a loss, you are not allowed to buy the same investment within 30 days before or after the sale and claim the loss. That's called the wash sale rule. If I sold this Fidelity fund and bought it back the next day, that would not count. So you got to wait 30 days or find a comparable investment product. Learn the implications of changing your filing status. Tax filing status can have a big impact on your tax liability. If you are considering a change, make sure to understand tax implications of making that change, is really what we're trying to communicate here. Married, filing jointly, you have a significant standard deduction, significantly more standard deduction. Remember, it's 15,000 per person. So now instead of 15, it's 30,000, and you would be in a lower tax bracket than filing separately. So sometimes there's life events, there's other reasons why people file single or married, but most often it is beneficial for two people that are together to file jointly. Higher income households may save money by filing separately. Seek tax efficient investments. Tax deferred accounts like traditional IRAs and 401k plans allow you to defer gains. Municipal bonds are generally exempt from federal income tax. So we talked about tax brackets before. If you're in the 32%, 37% bracket, municipal bonds probably for sure could be considered. And I think you should also have that discussion if you're in the 22% or 24% bracket, just to kind of rule out tax exempt or federally tax exempt income would not make sense for any bonds that you have versus taxable bonds. 529 plans and health savings accounts offer tax benefits that can help reduce tax liability. So 529 plans, it's state specific. In Illinois, the rule is, and that's really a savings on the state income tax, you can give up to $20,000, $10,000 per person away that's deductible by making contributions to a 529 plan for a grandchild, for your children. But that's only a state income tax deduction that's offered. Health savings accounts offer tax benefits, of course. If you're single, you can put $4,300 into an HSA in 2025. If you're married, you can put $8,550 into an HSA. And just know you have to have an HSA compatible plan. HSAs are built for high deductible health insurance plans, and then you can save that money in an HSA and invest that money too. Why use a financial advisor? Of course, hopefully some expertise and knowledge. A financial advisor can help retirees adjust their investment strategy and expenses to account for inflation. When we build financial plans for our clients, we're going to incorporate into those plans inflation on those expenses. Financial advisors have financial planning, investments, and retirement strategies expertise. So all three of those things, you need to have some strategy, you need to update your plan on an annual basis, and you need to have the right investments that fit the purpose and the goals for your money. Hopefully we can provide personalized advice and guidance based on individual goals and circumstances. I cannot tell you how many, I think it happens most with Social Security. As an example, somebody will say something like, I need to pull Social Security at full retirement age. And I'll be like, why do you think that? Well, because my friend did this, or my buddy did this, or I was at a family gathering and they were talking about this. Just because it makes sense for someone in your inner circle that you talk about your finances to take Social Security at a certain age definitely does not make sense that that rule would apply to you. So I think individualized financial planning is very important. Bring those things that you hear from others to us, and we'll have those conversations and we can model and plan for how that would affect you specifically. I think it's hard to apply a rule of thumb across the board to a lot of financial decisions. That's what I'm trying to emphasize. Objectivity. Financial advisors can offer an objective perspective on financial matters and help retirees make rational decisions. You know, fortunately, we did not really have this happen too often. I can think of at least one scenario where, you know, somebody, it's the end of September. Historically, October has been one of the worst months for the stock market historically. And then, you know, some people think they can plan and anticipate that. But this October, the stock market was up significantly. And 2024, the market's been up significantly. So this is just a reminder, you know, money is emotional. Bring those emotions, have those conversations with your advisor, and hopefully they can keep you invested. Customized plans. Always need to start with the end in mind. What are we aiming at? What is the end goal? How do we want to get there? What's going to be involved? All of those are going to be specific to our clients. It's not going to be a plan that we replicate for other clients. The plan is specific to that client. Monitoring and adjustments. There's things that come up like these tax changes, for example. That's why we're having this conversation. There's many things that are changing for 2025, but also as clients near retirement, they need to turn on from saving money into here to having the money come out from their investments. And we need to plan about 5 years in advance for that because the purpose of the money is changing to I'm not going to live on this to I'm going to start living on this within the next 5 years. So finances are not static. Things evolve, things change, people move, they buy second homes, they sell their primary residence, they downsize. So many different things happen. So monitoring and adjusting to that is important. Confidence. I think ultimately what this is saying is peace of mind. I think in a perfect world, I know we did a good job for that client when they do not worry about their finances. They do not worry about the assumptions we use in the plans. They know that those assumptions are conservative. They know that we're looking out for their best interest, and they have confidence, which ultimately leads to peace of mind with their investments. Using a financial planner can help you avoid a lot of common mistakes. It can keep you invested. It can keep you up to date on information. Information is power. So by having an additional set of eyes, I believe that adds a lot of value. So again, just kind of talking about our services that we offer, where our office locations are.